What if the greatest investor of all time, the man who built his empire on the simple rule of buy and hold forever, suddenly started doing the exact opposite? For the last 10 consecutive quarters, Warren Buffett hasn't been buying, he's been selling. Systematically, quietly, and on a scale we have never seen before. He sold so much, in fact, that Berkshire Hathaway is now sitting on a record-breaking $347 billion in cash. This isn't just a news headline. This is a lesson. And today, we're not just going to look at what he sold. We're going to understand why. Because Warren Buffett is sending the market a clear, powerful signal, and it's one we all need to hear. Let's be clear, this isn't just trimming the hedges. Buffett has been cutting into the core of his legendary portfolio. He sold over 600 million shares of Apple, reducing what was once over 50% of his portfolio. He's offloaded 400 million shares of Bank of America, a longtime favorite. He significantly trimmed his position in the oil giant Chevron. He's also completely exited positions in companies like HP, Floor & Decor, and even some S&P 500 ETFs, a move that shows this isn't about one specific sector, it's about the market as a whole. So the billion-dollar question, or in this case, the $347 billion question, is why? Why is the master of be greedy when others are fearful suddenly so fearful? The answer lies in one of his most famous yet often ignored principles: price and value. To Buffett, they are two completely different things, and right now, he believes the price of the stock market has become dangerously disconnected from its actual value. Think of it like this. You know your favorite coffee shop sells a great latte for $4. That's its value. But one day, you walk in and they're charging $10 for the same coffee. It's still a good latte, but is it worth $10? You'd probably say no and keep your money. That's exactly what Buffett is doing with the stock market. He's looking at the price tag and walking away. Let's look at the evidence he sees. First, the standard price-to-earnings ratio, or PE ratio, of the S&P 500. Historically, the average is around 15 or 16. Today, it's hovering around 28. We are paying nearly double the historical price for the same dollar of company earnings. But maybe that's just short-term noise. So let's look at a more stable metric, the Shiller PE ratio, which smooths out earnings over 10 years. That number is sitting at 38. To put that in perspective, it's higher than it was just before the 2008 financial crisis and is creeping dangerously close to the levels seen right before the dot-com bubble burst in 2000. And then there's his own creation, the Buffett indicator. He once called it the best single measure of where valuations stand at any given moment. It compares the total value of the stock market to the country's economic output, or GDP. Right now, that indicator is screaming overvalued, sitting nearly 2 standard deviations above its historical trendline. These aren't just numbers on a screen. To a value investor like Buffett, they are giant, flashing warning signs. They tell him that the risk of buying stocks right now is far greater than the potential reward. This brings us to the second and perhaps most important lesson: the power of cash. That $347 billion sitting on his balance sheet isn't lazy money. It's a strategic weapon. While other investors feel the pressure to be fully invested at all times, Buffett understands that holding cash is an active and sometimes brilliant decision. Cash gives him two things: safety and opportunity. Safety because when the market is priced for perfection, cash protects you from the inevitable correction. And opportunity because when that correction comes, when fear returns and prices fall back to sensible levels, his $347 billion war chest turns him from a seller into the world's most powerful buyer. He's not timing the market. He's simply refusing to play the game when the odds are stacked against him. He is patiently waiting for the fat pitch, that perfect, low-risk opportunity to swing for the fences. So what does this all mean for you? Should you sell all your stocks and run for the hills? Absolutely not. You and I are not running a $900 billion conglomerate. but we can learn from the discipline behind Buffett's moves. Here's the takeaway lesson for us. This is a moment to be cautious, not to panic. First, look at your own portfolio. Are you heavily invested in high-flying stocks with astronomical valuations and no real profits? Buffett's recent sale of a stock like Snowflake is a great example. He's not interested in stories. He's interested in earnings. Maybe it's time to reevaluate those positions. Second, don't be afraid to hold some cash. It doesn't have to be a huge amount, but having some dry powder ready not only protects you from a downturn, but allows you to take advantage of it. When great companies go on sale, you'll be able to buy. And third, focus on quality. Buffett still owns hundreds of billions of stocks like Apple, Coca-Cola, and Amerex Express. Why? Because they are fantastic, profitable businesses. In an uncertain market, the highest quality companies are the ones that endure. Warren Buffett's actions over the past 2.5 years aren't a prediction of an imminent crash. They are a masterclass in risk management. He is teaching us that true investing isn't about chasing returns in a hot market. It's about protecting your capital when discipline is forgotten and prices become irrational. He's simply following his own timeless advice. Be fearful when others are greedy. And right now, the market is very, very greedy. Thanks for watching. If you found this lesson valuable, hit that like button and subscribe for more insights into the world of investing. Let me know in the comments, do you think Buffett is right to be so cautious?